From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Inflation pops up a little in July, but less than expected, and it's now at 3.2% overall in the Consumer Price Index in the last year. Should the Federal Reserve declare victory over inflation and start cutting interest rates, as some folks suggest it should? Plus, President Biden issues a new executive order limiting some investment in China. But the order is more narrow than many people expected and is focused on high-tech areas. How will this affect the struggling Chinese economy, the U.S.-China relationship, and, of course, the world's second largest economy after the U.S.? Welcome. I'm Paul Gigot of the Wall Street Journal opinion pages, and I'm here with our two economic gurus at the Wall Street Journal, Mary O'Grady and Joe Sternberg. Welcome to you both. So let's start with the inflation report and what it suggests about the way forward here for the Fed and the economy. The Consumer Price Index came in at 0.2% for July, the second month in a row at that level, and that means that the rate for the last year, 3.2%, which is two-thirds decline, Mary, from the peak of 9.1% in June of 22. Time to declare victory?
Well, Paul, I think it's a little early. First of all, we're not there yet. The goal is 2%. So at 3.2, we're still got a ways to go. And it's always been expected that that last little bit is going to be the hardest to achieve.
Now, why is that?
Well, because, you've already raised interest rates over 500 basis points in a year. And raising interest rates is a very blunt instrument. So obviously the Fed could hike very rapidly more and it could wipe out the inflation, but it also would hurt the economy. So it's trying to do this very delicate balance of raising interest rates, taking credit out of the market just enough to kill inflation, but not enough to kill the economy. And so that's the game it's playing. And that's why there's some question about whether it should, I think it's way too early to start cutting, but whether it should make another increase of 25 basis points or whether it should just sit tight and watch the effects of the interest rate increases flow through the economy and bring inflation down that way.
But that last mile, if you will, metaphorically speaking, of getting down from 4.7%, which is core inflation, which is without food and energy in this report. So that's still even higher, including with services, are a lot stickier than goods. Getting there is tougher because you have to squeeze out that the expectations that have been built in to some extent in consumers and businesses that are passing along higher costs, I guess, especially in services.
Well, also the Inflation Reduction Act put more stimulus into the economy, so the Fed's also fighting against that. One thing that I would note is that core personal consumption expenditures, which is a different measure of inflation and the one that the Fed tends to rely on, is in the last report was down to 4.1. So I think Jay Powell has reason to be very happy with the trend, the direction of inflation and the fact that all of these increases have not killed the economy.
Joe Sternberg, do you agree with Mary that Powell has some reason for being pleased by this trend? Certainly the markets liked it today. They popped after what was considered to be a mild inflation report.
Yes, certainly I think that this is good news in the sense that a slower rate of inflation is much better than a faster rate of inflation.
So you're going to go out on a limb on that one, Joe?
I will generally not make a lot of economic predictions, but I will stand by that one. But, I think that the key point here is to understand, though, why it is that we actually care about inflation. I think that economically and politically, what's always at stake in this discussion is the fact that inflation diminishes people's standard of living because you have this change in the price level, and particularly a characteristic that has happened in the U.S. economy over the past couple of years is that people's wages have not kept up with the general price level. And so I think that part of what is happening here is that it might be that the challenge for the Fed and other economic policymakers is changing now that the rate of increase of the price level is starting to slow a bit, although, as Mary pointed out, still not to the 2% target that they're aiming for. What you have to do is figure out what policies are going to bring people's standard of living into line with that. One of the good bits of news from the data that we have today is that people's real inflation-adjusted weekly earnings are up for the second month in a row. That's good, but people still have a lot of ground to make up after the inflation of the past couple of years. So the way I think about the kind of last mile challenge that Mary was talking about a minute ago is that now that you've got the rate of inflation under control, the problem is which policies make it possible to continue keeping that future change in the price level contained while creating the conditions where households can actually catch up again and restore the standard of living that they've lost over the past 2 years.
Well, Joe, release on consumer prices was coincident with a report from the Bureau of Labor Statistics on real earnings, as you point out. But I see a 5-month in a row increase in monthly real average hourly earnings for all employers across the economy. That's average, okay, so obviously not for everybody, but that's a huge change from what had been essentially 2 years of declining real incomes since almost from the month that Biden took over as president of the United States. So there is some improvement there, and that is, if it continues, Mary, probably will have political implications as people maybe begin to feel better about their circumstances.
Yeah, I think that's true. I mean, I think it's so small right now relative to what was lost.
The wipeout.
Yeah. And of course, most experts are not expecting a recession before the end of the year. But the Atlanta Fed actually is predicting quite a strong third quarter. But, if we do hit a recession, that's also going to be tough on American workers. I think one of the things that could help, Joe was talking about policies, on the big problem that the Fed is facing is in the service sector, where because there have not been enough workers, there's always pressure on labor. And the administration and Congress could help a lot in that regard if they would restore some of the immigration policies that let more people legally work in this country. I mean, that could take a lot of pressure off the Fed and basically off the services sector.
But you don't think that all of this illegal immigration is doing some of that? I mean, we've had 2.5–3 million a year coming in over the border. Now, granted, most of these people are low-skilled workers, but they're filling in all across the service sector on restaurants and resorts and construction.
It's hard to know how that data is picked up because they're illegal. So they're not on the books in the same way they would be if they were paying employment taxes and payroll taxes. So I think it's a big question mark. I do think that labor is helping, but you hear the mayor of New York City constantly asking Joe Biden why he won't let these people work. And I think it's an excellent question and something that could really help in terms of, the inflation pressures in the service sector.
Yeah, just to elaborate on that, Mayor Adams said he expects 100,000 immigrants this month that have come over illegally and are stuck with, now the permission to come in, but they are arriving in New York and they can't work for the first 90 days.
That's what happens when you call yourself a sanctuary city.
And Joe Sternberg, you've perched in London and you've watched, of course, the impact of inflation on the politics and economics there. How long is it going to take for an increase in real earnings to have a psychological impact on the public and how good they feel about the economy?
I think that it can take a while because people have to start feeling materially better off than they were before. So, it is correct that real earnings have been increasing for a while now, but sort of if you compare the level today to where we were back in January of 2021, there is still some ground to make up. And I think that the key thing is that people have to feel that their standard of living has made up the ground that they've lost. And I think it's also important for people to feel like there is a prospect that the improvement will continue, that you haven't done all of the suffering over the past couple of years just to end up where you were at the beginning. And so I think that is kind of an expectation element here that's really important. And I think that what can help politicians a lot is if they have come up with a mix of policies that are creating an economy where you have a lot of innovation and entrepreneurship that has been unleashed, where people feel like there's a lot of new business investment going on around them, that there are always new opportunities coming up. I mean, that is a sign that the productivity in the economy is firing on all cylinders again, and that will really make people feel like the regaining of the standard of living that they've made up is really there to stay.
If real earnings do increase, you could see and inflation continues to fall, you could see a situation in a year from now when, of course, we'll be at the height of the election campaign, when presidential and congressional, that inflation is not nearly as big an issue as it has been, and that would certainly help President Biden and the Democratic Party. All right. You had a last point on that, Mary?
Well, I just wanted to say that this week we got from the Federal Reserve, New York Federal Reserve, that consumer credit card debt surpassed $1 trillion. So maybe if inflation is tamed, but we're in a recession and people have lots of credit card debt, that's not going to be so good for the Biden administration.
Well, that would be ugly indeed. Yeah, that's for sure.